Today we'll learn about personal finance. I'm pretty sure a lot of you have been, bombarded with finance content on Instagram. Thanks to the boom of creators like us, everyone's talking about finance. But it should be the case. It's very important that you learn about how you manage personal finances for yourself and your business. Right. On that note, I'll get started. First, what are some of the instruments we have access to? The traditional instruments are savings and fixed deposits, right? Everyone here, I'm pretty sure you've heard about savings and fixed deposits. And also, you guys have heard about gold. Why you guys have already heard about this is something that our parents love. They love keeping their money stacked up in the savings bank or the FDs. They buy gold and maybe they make use of it after some time. But there are other instruments which have been gaining popularity. For example, mutual funds, stocks, cryptocurrencies, the new fad. These are the instruments that we have currently. For someone who's starting very young, there are two advantages here. One, you have the time on your side. Why do I say this? Stocks and mutual funds are perceived. Let me make it very clear. They're perceived to be risky. Now, risk is a function of time. I agree. If you are investing in stocks with the hope that you'll double your money in the next 2 to 3 years, that is going to be risky. But you're investing your money in stocks or mutual funds for 7 to 10 years, the risk reduces. Why? Because stock markets moves in cycles. There is up cycle, there is down cycle, and overall, if you stay invested for a very long time, you will see that your risk almost comes to bare minimum and your returns will be 3 times that of an FD, or at least 2 times when compared to a fixed deposit. Currently, a fixed deposit gives us a meager 5.5 to 6% annually. And unfortunately, the inflation in India is 6%. So your 100 rupees today might grow to 106 next year, but essentially you will be able to buy the same amount of things that you could buy today. Even though the money has increased in terms of numbers, it has not really increased in terms of what the purchasing power your money has because of inflation. Now, this makes it very important for us to be curious as to how can we look or invest into certain instruments that will give us a better returns, give us returns that will beat the inflation. What are the instruments we have that can possibly beat inflation? One is mutual funds, two is stocks, three is gold, and fourth is cryptocurrencies. We'll get on that later. It's quite a fascinating subject. I'll give you a brief about what these are. Fixed instruments are very simple. I'll tell you how it works. You give pesa to the bank. The bank takes that pesa and gives it to others in terms of loans. They make their cut out of it and they give you your 5-6% or whatever. They can invest that into bonds or give it out as loans to corporates or anything that they can do anything with that money, right? And then there is an insurance of 5 lakhs. Let's say your bank goes bonkers. Then there is a deposit insurance of 5 lakh rupees. Mutual funds, there are two types in mutual funds. One is called as equity mutual fund. Second is called as a debt mutual fund. What is equity mutual fund? Very simple. Let's say Aditi is a mutual fund manager here, and I have absolutely no idea about stocks. Okay. But I've listened to my friend that investing into stocks can give me great returns in the long term, but I do not have the time to dabble with stocks or learn about stock markets. But Aditi here has been doing that for the past 15 years. She's been a fund manager for a big company called Kotak or Axis Bank, and she's been handling crores of rupees, which means Aditi will pick the stocks that the fund will invest in. Aditi will do the balancing in terms of how many shares should Aditi buy, what price should the shares be sold at, should any new shares be added, should Zomato be added to the portfolio or not. She'll decide that for us. And we pay a very small percentage in terms of 0.5 to 1% as fee to Aditi. So this is equity mutual fund. So I, without having any idea about stocks, can simply start an SIP. SIP is you investing in a systematic way of 500 rupees in Aditika fund. Isn't that nice? Why? You don't need the knowledge to get started because you're trusting Aditi, and she's been doing this for the past 10-15 years as a fund manager. Plus, the historical data suggests that equity mutual funds give a return anywhere in the range 13 to 21%. Now, why is the range broad? Because there are multiple types. Again, I don't want you guys to get confused because this is a very introductory and a basic session. There are again different types based on the types of companies Aditi invests in. Then there are debt mutual funds. Debt mutual funds are, let's say, I am your fund manager now, and I invest into debt or loan instruments. Basically, if the fund manager gives out loans to corporates and governments, and they get X percentage as returns. Usually, these will be higher than your FDs, which is why people say always invest your emergency fund into a debt mutual fund. I'll get on that later, get to the emergency fund later. Third is stocks. I told you how to get started with equity mutual funds, which is indirect way of investing into stocks. But the direct way of investing into stocks gives you more returns. For example, you can buy shares of Infosys, you can buy shares of TCS, you can buy shares of Colgate, you can buy shares of Zomato directly. You don't need to go to a mutual fund, subscribe for it, and then get an SIP going. But here you need to have some level of education about stocks. Just because your friend is buying Infosys, you cannot go and pick that stock. Your friend might be buying Infosys for XYZ reasons. Now your friend may exit the stock all of a sudden, and then you'll be like, dude, you didn't tell that to me. Then your friend will be like, I never told you to invest, dude. It's my choice. So always understand what stock markets are. I've seen people complaining ki it's confusing. There's lack of info. In 2021, you cannot be complaining about information. At least I understand there is over information, but you cannot say there is lack of information. But yes, there is over information. What you guys need to do is figure out who you would want to follow in terms of your financial creators or some channels. Zerodha Varsity is great to get started in terms of stocks. There are some beautiful YouTube channels from Rachana Ranade, CA Rachana Ranade. You can get started there. Follow 2 to 3 creators, educate yourself. But the best way to get started would be get started with an equity mutual fund. Then after some time, slowly start dabbling with stocks. You will get confident. Unless and until you get your hands dirty or you start investing, you will just read and do nothing about it. But as soon as you start putting money, you'll start being curious, and then you will definitely want to know more about stock markets, etc. The instruments are clear. We'll talk gold. You guys know gold is gold. You people, our parents love gold because it glitters and it is tangible. They can touch and feel. But unfortunately, it's not a great instrument because the returns is deteriorating over time. And with the introduction of cryptocurrency, Bitcoin is being touted as a digital gold. So I personally feel there will be a shift, at least in the millennials. They will not see gold as an investment instrument. They will shift towards Bitcoin. But again, that's my personal view. But if there's one thing everyone here needs to do, that is a lot of our parents make investments in our name, right? Beta ka, beti ka education ke liye, or beta ka shadi ke liye, and they start when we are 15-14 years old. Now, if they're doing investments on your name and you're aware of it, and they're putting into instruments like fixed deposits, gold, they're essentially not making the best use of their money. Why? Because buying physical gold has a lot of disadvantages. For example, one of it is you'll have to pay GST on the purchase of physical gold. 2, there would be making charges. 3, there would be always that fear of theft. So you would obviously go spend extra on storing that in a bank locker. Again, there is always insecurity there. Plus, it is not a tax efficient way. Physical golds are taxed at 10% if you hold it for more than 3 years. There are multiple tax slabs. Whereas if your parents are hell bent on buying gold, then there is one instrument called sovereign gold bonds. It gives you exposure to gold, but there are some advantages here. Why? One, there is security of RBI because gold bonds are issued by the Reserve Bank of India. Two, you get 2.5% over and above. Let me repeat this, 2.5% over and above the market price movement of gold. Let's say you have invested, your parents have invested 3 lakhs in physical gold. Kuch nahi milta hai. Whereas here, you get 2.5% every year on that 3 lakhs. Plus your gold price ka appreciation also you will get. And if you keep this for more than 8 years, it is completely tax free, which means, let's say when you bought, the gold was 4,000 per gram, and after 8 years it has reached to 6,000 per gram. You've made I don't think it will increase by 50%, but let's assume that you've made a gain of 2,000 per gram. Okay, you don't have to pay any tax on it. But otherwise, in physical gold, whenever you sell the gold, you'll have to pay long-term capital gains tax.